We're here to help you better understand the Silicon Valley real estate market by sharing up-to-date weekly data. These are the key chapters we're going to be going over in the next 45 minutes, roughly. We finish up with 5 regions, including all the 13 counties and 5 regions of Northern California. The focus, though, is Silicon Valley, Santa Clara, San Mateo, and Alameda counties. Each one of these chapters has a YouTube link in the description where you can go right to the timestamp so you can go to the section you find most interesting week after week. Let's get into the data. Here's the first data slide. We're starting off with inventory. These are the available properties that don't have an underlying offer on them. I don't include the contingent offers because the initial buyer has first right of refusal. So these are just available properties for anyone to walk in and make an offer on. You can see we started off 14 weeks ago, 13 past weeks plus the current is the 14 weeks. So it's the current week plus a quarter. You started off at 2,600. We're down to 1,441. So our inventory is cut in basically half, but the percent of normal is 85% versus 89. So the rate of reduction is almost completely normal, even though you've had a reduction of half of the available inventory in just the last 14 weeks. You can see the normal trend. The gray line is defined by the 10-year median. The 10 years used are 2014 through 2013. So the past 10 years, the current year doesn't impact that previous 10-year data points. The blue line is the coldest inventory you'd expect, which is the most inventory, the least number of offers. The gray line is where you expect it to be the median, and the red is the least inventory you'd expect, which is the 10 percentile. Or in the case of offers, it would be the most. So that would be the 90 percentile. So I go from 10 to 90 percentile, highlighting where the median is. You can see it followed the normal trend, and it's about the same distance away from the gray line, which is why the percentage change is about the same. Same concept with the number of offers accepted. Here you've gone from 1,900 to 1,535. So you've only lost 400 offers. And here, the market share has actually increased. It went from basically 77% to 82%. So you gained roughly 5% of your market share, even though you've lost 400 transactions. And again, you can see the pattern compared to normal. You can see that even though percentage-wise it's the same, it was below the least you'd expect at the beginning, and now it's above the least you'd expect at the end, even though the percentage is roughly the same. Just an indication that, the market's getting a little tighter and dropping down, so it's a little more consistent. Days on unsold inventory, DUI, is the seller-buyer supply-demand balance. And in a free economy, that's what's supposed to contribute to the future pricing. So as this becomes more robust, and it's almost always fairly robust, fast-paced in Silicon Valley, there's more upward pressure. As it slows down, there's less upward pressure. You can see it's basically right where it typically is for this time of the year. It's 52 versus 49. It's 96% of the normal speed, so just 4 percentage points a little bit faster. At the beginning of the quarter on the left-hand side, you can see it was 11% slower than normal, and you can see you were above the gray line, and now you can see you're just a little smidge below the gray line. Days on market, 75th percentile, is how long it takes 3/4 of the sellers to sell. I don't look at the median because the median is often selling as soon as the seller will accept the offers. I don't want to go out to the 90 percentile when I don't have to, and I do feel I have to on price adjustments because so few sellers do price adjustments. But on days on market, I can keep it a little more eccentric, and I look at the 75th percentile or the third quarter. You can see, although you've gone from 26 days to 44, the percent increase has been from 107% to 129%, a gain of about 22% or almost a quarter of the marketing time. You can really see the change in just the last 3 weeks. 3 weeks ago, you were right at the normal line. And instead of following the normal line, it increased a little bit to go longest time you'd expect on marketing. Then it increased again last week, and then it increased again this week. So it's been a very rapid change in just the last couple of weeks. And it's something that is noteworthy and worth keeping our eyes on going forward. Price reductions, this is the average price reduction. So it's a measure of the seller's expectations when they listed the property with their original list price compared to how much they had to adjust their price down. And this is the asking price. So their adjustment to offers accepted price may be higher or a lower number, but this is original list price to list price at the time the offer is accepted. You can see that it was 9% higher. This is not a 9% price reduction. its basic decrease is 9% higher. So right now the decrease is 91%. That's 9% higher, rounded up to 10%. So in rough terms, the previous balance would have been about 83 because 10% on top of 83 is 91 if I'm doing my math right. Now you come over here and now you're 16% more with the seller doing a 1.2% price reduction. The reason it's so small is the vast majority of the sellers, somewhere around to 85%, make no price adjustments at all. And so you have a whole bunch of zero adjustments. And it's a lagging indicator, but we look at overbid because it's a measure of offer competitiveness. It's something that a lot of consumers out there want to follow. We were overbidding 5.6% instead of 4.9%, 0.7% more overbidding than normal as far as magnitude. And now we're at 5.3 versus 3.8. So if I'm doing my math right, that's 1.5% higher. So you've doubled the amount of overbidding compared to normal. You can see that you're much further away vertically from the gray line now than you were on the left-hand side at the beginning 13 weeks ago. Now what we look at is the three components that make up a marketplace: the supply, demand, and the ratio between the supply and demand. We go all the way back to January 1st of 2014. Each dark vertical line is a year. We come up on that scale all the way to January 1st of 2023. Then we have what I call the expanded date scale or the horizontal scale. And we do that so it's easier to see trends. If a whole year is in this space here, it's hard to see trends. By blowing it out, you can see trends a little bit. And then the current year is also on that same expanded scale. The purple line is the current inventory, and you can see that your level of inventory is basically somewhere around 85.5% of normal. Your offers is the orange line, and that's about 82% of normal, fairly close to the same level. You would expect the days unsold inventory to be higher than the normal because the number of inventory is at a higher percent than the offers. In this case, you're just a little bit below, you're at about 96%. And the reason I know the data is accurate is I've looked at it because initially it caught me by surprise. But as it turns out, the median number of inventory, the median offers, and the median DUI happen in 3 independent years. You don't have the 3 performing their median in the same year. So you're not comparing data on the same year. If you were, then the gray line would have to be higher. But because they're coming from different years, they're close to 100%. And I would call it 96%, essentially 100%, and call it a normal year. So the speed of the market's normal, even though we're missing almost 20%, call it 18%, call it 16% that we're missing it. You're missing a good chunk of the marketplace. 1 out of 5 transactions is close to me missing. Now you're looking at the same concept where we go back all the way to January 1st of 2014. But what you're showing is just the inventory. So this red line would be the least amount of inventory you'd have because that red favors the seller. This would be the most inventory you'd expect to have, and the gray is where you expect to have. You can see the purple is in between the red and the gray, closer to the red line, but it is vertically separated straight up a little bit. Even with the expanded scale, it's hard to draw a vertical line and see exactly where I should be crossing. But the current inventory is something around 1,450 listings. And the least you'd expect is something around 1,350 would be my guess reading it, but it is hard to read vertically. What I do here is I take the gray line, the curvy gray line on the previous chart, and make it a straight line and say, what percentage is the current data of normal? And that's where you're getting that 84.5% of normal inventory. And that's about what it was from memory. Looking at the offers, same concept where your offers are between the gray line. And again, you go vertically. So the number of offers you'd expect is up here somewhere around 1,700. The number of offers you have is really about 1,550. So you're missing around 10% of the offers. We actually saw the number earlier, and I think it was closer to 20%. So that tells you how much I'm skewing my line when I'm trying to draw vertically. It's really hard to tell a straight vertical up line. And so you're between the typical, the gray line, and the blue line, which would be the least you'd expect. So again, we're missing offers. Here you can see the gray line stretched out. You can see that we're about 82%. You can see we've gone up a little bit. But the trend here, it's been moving up and down a fair amount, which is sort of surprising. You'd expect with using a 5-week moving period that I'd have a little bit more stability than I actually do. but the trend is up. You can see that in 2023, the trend was basically flat and at about 70%. We basically, starting in second quarter, have started to grow, and we've gone from basically 70% up to about 80%. Where it will settle out is, is it going to keep climbing and be 90% in another couple quarters, or will it jump up? Or, there's no way to know what it's going to do in the future, but it has been climbing. So we have been welcoming some of the buyers back into the marketplace, which is always good for the industry. Here's the same concept for the number of days unsold inventory. Here you can see that you're very close to right on top of the gray line. The speed of the marketplace, the pressure the buyers are feeling is what it normally is. The turnover rate is the same. DUI is basically the turnover rate. How quickly would you sell all your existing inventory at the current rate of sales? Here you can see that you're just a little bit below 100% of normal level of days of unsold inventory. A low number of days of unsold inventory is a faster marketplace, so you're slightly on the fast side. But I would wager that anybody out in the field would experience just a typical fast-paced Silicon Valley. And for whatever reason, Silicon Valley has been a quick pace for the last several years. Here you're seeing the days on market, and you can see from basically shortly after the beginning of fourth quarter, it's been going straight up. Now it normally goes straight up, but it started off below the gray line, and instead of having this correction this current week, it actually shot up higher. So you're having a significant increase in the number of days it's taking to sell the property. My best explanation of why is sellers are taking larger price reductions after they've been on the market for a while. That's re-generating that interest in that property. Then the buyers are coming in and overbidding, but buying a property that's been on the market for 60, 90, 120 days, causing it to increase. Now, we're not at 120-day level when you look at everything, but we are at 44 days, and we'll see the breakup between the different counties later on. Here you can see compared to typical. If it was typical, we'd just be down on the gray line. So just 2 weeks ago, we were on the gray line. So you've gone from 100% to 110% to 120% to 130%, all in basically 2 or 3 weeks. So the rate of change is what's very noteworthy and worthy of taking note of. We have seen increases like that before. As the market was slowing down in 2022, the market climbed rapidly. So there has been times when it climbed rapidly, but where is it going in the future is the more interesting part. It climbed rapidly with the COVID shelter in place, and we couldn't even show properties. In fact, it goes off the top of the scale. It's going to be worth keeping an eye on here. Even at 130%, you're basically only have a few spikes that were higher. It is abnormal to be at this level of days on market. Here is the asking price reductions that we talked about. This is the one that I think is more valuable. I'm ignoring 90% of the market and just looking at the extreme. I'm looking at the extreme sellers that are taking the largest 10% price reductions. And you can see that just 2 weeks ago, we were right at 100% of normal, right on top of the gray line. And now you're down here significantly below the gray line. You're not down to the blue line yet, but we are approaching the blue line. You're somewhere around 85% of the sellers. So that means they're taking a 15% price reduction. And that's not all sellers. That's only the 10% of the sellers that are taking the biggest price reduction. Here's compared to normal. So you can see that we were higher than normal, but look at this rate of change in just the last couple of weeks. We dipped down in Thanksgiving. We were basically right at normal. And then we've jumped 25% since Thanksgiving. That's a pretty rapid change. And that's 25% compared to normal. Here's now looking at the more traditional method of looking at the average. You can see the magnitude is a lot smaller. We're talking about a 1.2% price reduction. Basically not very much. A normal market would be at this time of the year would be right about 1%. So you're taking about a 20% larger price reduction than you typically do. And I think the number from earlier in the presentation was 19%. But you can see why I don't like looking at average. It's such a tight little metric. Here's compared to normal. You can see that we're taking a little bit larger number of price reductions than normal, and that's in magnitude. This is the frequency, and it's a little bit more common, but it's basically right at the gray line. The gray line is normally something like 19%, 19.5%, and we're at about 20.5%. So very common, very expected level of price adjustments. So what's really happening is the sellers that are taking those larger price reductions are the people that are taking significantly larger price reductions than normal. Here's pulling out the gray line and making it 100%. And you can see that, as I said, just a couple of weeks ago, we were down at 80%. So we were faster than normal with taking less price reductions. Then we got up to normal. And now we're above normal, somewhere around 7-8% larger price reductions than normal. And that's on average. And it's not the frequency that's off by significant. So the reason it's larger is those 10% of the sellers that are taking those large price reductions are taking larger price reductions than they typically do. Here's the median overbid, or later we'll be talking about the average overbid, which I think, or we actually talked about it earlier too, somewhere around 5.8% or 5.5%. The median overbid is only at 2.5%, so a much lower number. And that's sort of like the sale price, where the median sold price is always lower than the average sale price. Same concept where we take the gray line, and that's the curvy gray line always at 100%. And so right now we're taking about 1.5% larger overbidding at the time. Again, this is the average of all the transactions. So if the normal overbidding was, say, 3.5%, the current overbidding would be 1.5% higher than that at 5%. Here's the frequency of overbidding. So how common is overbidding? And you can see it's basically 62% of the sellers are getting more than their asking price. So that's just a little shy of 2 out of 3 sellers getting more than their asking price. Just a couple of weeks ago, we were at or slightly above the 2 out of 3 sellers getting more than their asking price. But the frequency is higher than it typically is. It's typically down somewhere around 58, 57.75% of the seller getting more than their asking price. And here you can see the horizontal gray line at 100%, and you can see the data lines at somewhere around 8% more sellers. So it's 8% more common. So if it used to be 2/3 and it's 8% more now, that would be somewhere around 74% of the sellers are getting more than their asking price. But anyway, 8% more typical than normal, and that's compared to normal. Here's your long-term appreciation line. That would be the straight blue line in here. The actual purple line is the actual data. To me, there's some real key takeaways here. You have the V down at the end of every year. A lot of that has to do with shifts in the marketplace, but you also have this upside down U in something like 9 out of the past 11 years. And that's where we have market overshoot. In real strong years like 2020, the market was so strong that it never came back down. There was even the V at the end of the year was abbreviated and more like a U. Typically, you get overshoot, or 9 out of 11 years, you've had overshoot where prices go up and then they come back down just almost immediately. Here is looking at the percentile. So the blue line at the bottom is the cheapest 10 percentile home in Silicon Valley in the 3 counties. That payment would be about $6,500, maybe $6,750. The median home mortgage payment would be about $12,000, and the most expensive you'd expect to be is somewhere around $26,000. That assumes an 80% loan at the national average and an estimate for property taxes and insurance. So an estimate of your total property tax payment at the different price points. Now, what we're doing is looking at a distribution of every property that transpires. And when I say every, I only look at starting at the 10 percentile all the way up at 90 percentile. So I'm looking at the middle 80% of the marketplace. That gets me away from statistical abnormalities, typo errors, things of that nature. And it allows you to see the scale pretty well, expanded. If you started putting in the extremes, you start getting a lot more compressed scale in the middle. So it's a trade-off. Each line on here is a different week. We start off a year ago with the blue dotted dashed line. We end up with the purple line, which is the current line, which is actually, as you can see, quite a bit cooler. It's closer to the record low. I start off jumping 4 or 5 weeks, trying to keep the data, which is the middle number, roughly the same. And you can see I've more or less accomplished that. We'll step through this and we'll see that the blue line immediately goes up 1 week right there, and then immediately turns around and goes down. Now it's accelerating, getting towards the peak. That's essentially the peak of the marketplace. That probably is right there. And now it's going to cool down fairly quickly. And basically 5 months ago, from 4 months ago, there really hasn't been much change. You can see the lines now are on top of one another. And now we're in weekly data. So instead of 4 or 5 weeks, it's data every week. And you can see there's not much movement, and now it's starting. Just so for the last 4 weeks, right there, really 3 weeks ago, 2 weeks ago, a week ago, in the current data. It's basically the last 4 weeks where the marketing time has started to increase, and we're basically pretty high now. We're above where the record high from last year. You can see the dotted line through here. So not only are we higher than we are now, we're higher on the record high. Now, there may be a week, since I'm jumping at 5 weeks, 4 weeks ago or 3 weeks ago last year, it might have been higher than the purple line, but you're basically already at the valley, and we know we have more time to go. This year is going to be having longer marketing times than last year. Now we're looking at price reductions. Here, I'm only looking at from 2.5% to 17.5% of the sellers. So I'm only looking at 15% of the total marketplace, and that's skewed to the very top end. And that's where the price reductions are going. In fact, I can demonstrate that because if you look at all these lines, the bulk of the lines are already at 100% before you're at 17.5%. That means all the data above 17.5% is going to be zero, which would do nothing but compress the line. That's why I focus on trying to get numbers that are representative. Typically, when you're doing statistical analysis, you don't look at the top 15% down, step down by 2.5%. That's just not something you typically look at, but I think it gives the best overall representation. The same concept, the purple line is the current line. We're starting off on the blue line a year ago, and you're going to see that one point right there cools down a little bit, and now it's dramatically up here. There's the peak of the marketplace 8 months ago, 7, 6, 5, and now you're basically stable, 4, 3, not really any change. And now your weekly data. So the market goes up, overshoots, comes down fairly quickly, and then stays at that plateau for a while before we start cooling off at the very end of the year. So now we're getting close to the point where I expected to start going off. Right there, 3 weeks ago, 2 weeks ago, much cooler, 1 week ago, and the current. So that's the trend that you're seeing on both of those. Now we're going to the third distribution, which is overbid. This lags behind. So since the other two have changed in the last 3 weeks, and the time for an escrow to close is approximately 5 weeks in under these market conditions, I would expect there not to be any major slowdown showing in the overbidding. But we'll start off on the purple line. You can see that the dotted line goes down a little bit. Right there's the bottom. Then you start accelerating a little bit, then a whole bunch, another whole bunch. Now you're sort of at the peak, and now you start cooling off stepwise. One more high number coming up, right? Oh, I thought there was one more high number. So now you're in the summer plateau, and I'm not anticipating a turn down. 7 weeks ago, 6, 5, 4, see no real change. 3, 2, 1, and current. So basically, we're not seeing any slowdown in the last 3 weeks on the current data on the overbidding because it's got about a 5-week delay. So 2 or 3 weeks from now, I would expect to start seeing a slowdown in the overbidding. Now we're looking at the active inventory, and instead of comparing it to the historical values, we're comparing the three counties. San Mateo County in the orange at the bottom, Santa Clara County in the blue in the middle, and Alameda County in the gray at the top. To me, the most noteworthy things are San Mateo County has roughly the same inventory as it typically does. Santa Clara and Alameda historically, pre-pandemic, were roughly at the same level. And even post-pandemic, they're roughly at the same level. 2017 back here was an exception. So the fact that Santa Clara has significantly less inventory than Alameda is unusual. It's happened before, but it's a 2 out of 11 years, so not very common. But that's what we have now. So Alameda County has more inventory than Santa Clara. So Santa Clara has the biggest shortage, followed by Alameda, and then San Mateo, with San Mateo being the closest to normal level of inventory. Now we're looking at offers accepted. San Mateo County has the least number of offers and significantly less than they typically do. So San Mateo had about the same level of inventory, fewer offers. I expect it to have a higher days of unsold inventory than it typically does. Here, Santa Clara has roughly the same number of offers accepted as Alameda. They're neck and neck with each other, and Santa Clara had significantly less inventory. So I'd expect Santa Clara to have a significantly faster days of unsold inventory than Alameda County. And that's the next slide. Here, Santa Clara County has the fastest days of unsold inventory, the fastest turnover rate at about 26 days to sell all your inventory. Then you have San Mateo County, which is in second place, but that is quite a bit slower than it normally is. In fact, if you come back pre-pandemic, the orange line was basically near the bottom of the three lines all the time. Now it's towards the top, and it's in the middle, but it's towards the top. And Alameda County has a much slower, longer DUI than Santa Clara County, which is what I said from the previous slide at 38 days. Here's the marketing time. Notice all three counties have gone up fairly rapidly, subsequent to the start of fourth quarter. So that's the increase. And this is, you have an increase typically, but from our previous data, these increases are more than they typically are. If I was to look at it, Alameda County, it looks like it has the biggest increase in marketing time measured by the 75th percentile, and it had the most price reductions. Again, that gives credibility to my hypothesis that sellers are reducing their price, therefore selling properties that have been on the market for a long time, which raises the 75th percentile days on marketplace. Here's the magnitude of list price reductions. So this is seller reducing their own price before the offer comes in. This is the average overall. You can see Alameda County in the gray is doing the most at about 1.6% price reductions, followed by San Mateo County at about 1.3. Santa Clara in the blue has the least amount of price reductions at about 0.7%. Here's the frequency of price reductions. Alameda County in the gray has the most frequent price reductions at almost 1 in 4 sellers reducing their price. Then San Mateo County at about 19%. And finally, Santa Clara County at about 16.5% of the sellers are reducing their price. Here's the magnitude of the three counties. San Mateo County and Santa Clara are dead even at about 105%. Alameda County, even though it's got the longest marketing time, has the highest overbidding at just shy of 6%. Now, again, it might be that those sellers are taking those large 10% price reductions after not selling for a while, raising the DOM, but they're also now undershooting the marketplace. So even though they've been on the market with their new price, they're attractive and buyers come in and overbid by 6, 9, 3% to get the average of being at 6% above the seller's ask price. Here's the frequency. Santa Clara County actually has the least frequent overbidding, and that's sort of surprising. It has the fastest market. You'd expect it to have the most pressure and the most overbidding. It's basically tied with San Mateo, but San Mateo County is clearly a little bit more overbidding. And Alameda County, the county that's got the most overbidding, has the most frequent overbidding. It also had the largest magnitude from the previous slide. Here's the long-term appreciation. Santa Clara County has had the best appreciation at about 95%. San Mateo is in second place at 75%, and Alameda County comes in at 70%. You can see before the pandemic, they were very close together. It's a little surprising that Santa Clara has the best post-pandemic appreciation. I would have expected more outlying areas with remote working. Here's the long-term sale price. This is on log paper, which I prefer. The horizontal lines are so you can come back and see at what level the prices were above and below. So you can see San Mateo County in the orange is basically back to their 2021 price. Santa Clara County is significantly above their 2021 price. And Alameda County, like San Mateo, is essentially at their 2021 pricing. There's been a lot of fluctuation in between, but not really any movement in price. Here's the same information on regular paper for those that prefer with the horizontal line, so you can come back and see where it crossed over. Here's the estimated payments going through the 80% loan. You can see that San Mateo County has the highest payment, followed by Santa Clara at about $14,000. And the most affordable is Alameda County. It's somewhere around $9,500 a month for a principal, interest, taxes, and insurance payment, assuming an 80% loan at the federal national mortgage rate. Now we're getting into what I think is important, which is micro markets. We start off with Silicon Valley being indexed as number 7, Santa Clara County is indexed as number 10. And then the 7 micro market areas in Santa Clara County are 11 through 17. San Mateo County is 20, 21 through 26 of the 6 micro markets in San Mateo County. 30 is Alameda County, and 31 through 37 is the 7 micro market. It's in Alameda County. You can follow the number or the area. I have the area described out in common names here, and then you can see them on the map where the different areas are. The takeaway here is look how pinkish the map is. So they're telling you right off the bat, there's a shortage of inventory. The one exception is Foster City, but it's so small, it would have no real impact on the overall marketplace. So clearly a lack of inventory. Now you're looking at offers. Now you got a nice blue map, except for Palo Alto, Los Altos area, right through the northwest portion of Santa Clara County. Clearly, blue is the color in vogue, which means a lack of offers, which favors the buyer because there's less activity, less competition. And then the balance between the two, the supply-demand balance, here you can see that Alameda County is basically white. And for the first 3 slides, I only have county-wide data for Alameda County. You come down to Santa Clara and you have some blue, you have some pink, and you have some white. So you got all 3 micro market conditions, and you have all 3 up in San Mateo County. So it really depends on where you're looking, what kind of conditions you would have. Now we're looking at days unsold inventory by itself. So now I have micro market data for Alameda County. You can see Livermore is a fairly fast-paced area, Fremont, Dublin, Castro Valley. So overall, a fairly fast marketplace. You get up into Hayward and Oakland, and it's sort of more of a balanced marketplace. And you can watch the actual values over here on the side. Right off the bat, you can see the darker red here in Campbell, and that appears to be the fastest region. The slowest is going to be a white, so I would go down with Atherton at about 74. You got 62.5, you got 61.7. So you can see real quickly what you're looking for. But the advantage of micro market data is that similar group properties geographically close together, so you get better idea of what's going on with the individual property values without having to do a million CMAs. Here's marketing time on that 75th percentile. How long is it taking 75% of the sellers to sell? You can see that most of the area is white in color, which means you're taking between 3 and 6 weeks to sell. Morgan Hill, South County of Santa Clara County, and the San Mateo County coast are the 2 areas that are clearly taking the longest time, with the coast taking 128 days. Morgan Hill, South County being roughly half of that at 66. But the bulk of the areas are below 45 days. You got 51 days in Atherton, but 47 days in Hayward, 64 in Oakland. But overall, just looking at this, most of them are balanced. Balanced white and color would be somewhere between 21 and then 42. Here's the average ask price reduction. So this is including everybody in the blender, so it's a pretty tight metric. Here you can see some price increases in Foster City, a 1% increase, which is pretty high. Even a 0.5% in San Carlos, which is pretty high. You can see anytime your 0.5% is saturated. So from a 0.25% price reduction to 0.5% increase, you're going to be a shade of pink. You can see Morgan Hill is, doing no price adjustment whatsoever. It's rated 0. The affordable areas of Santa Clara County is a 0.1% price increase. So that does happen. Sellers are getting more activity than they anticipated, so they raise their price to throttle back the level of activity, because I subtract out and correct typographical errors and data entry errors and things of that nature the best I can. Now we're looking at the frequency of price adjustments. How common are they? You can see the only blue area in Santa Clara County is Morgan Hill at 25%. San Mateo County's got a blue area at 64%. So almost 2/3 of the sellers in the Half Moon Bay area have been doing price reductions. Alameda County is around 25% for Castro Valley, Dublin, Livermore, and about 35% for Oakland. So you got a mixture of blue sort of in the outlying areas and red on the closer in areas, and then white sort of in the in-between areas. Here's the magnitude of overbidding, so the pressure the buyers are feeling. Basically pink everywhere. So across the board, buyers are feeling pressure and going in over the asking price, with the highest area being Berkeley in the city of Alameda at 15%. The least area that I'm seeing right off the bat is 1.1% for the Half Moon Bay Coast, and then 0.6% price reduction for Pleasanton. That means buyers are going in and actually reducing the seller's ask price by 0.6 when they write their offer. Here's the frequency of that overbidding. Again, across the board, you're red in color, which means you're above 50% because you're going to be white from 33 to 50%. It looks like Redwood City is white in color and it's at 49%. The coast is also at 45, so white in color, and Atherton at 33. So you got a little area, a fairly significant area in San Mateo County, but they're just two of them are just below 50%. Here is price appreciation since the last 9 months of 2015. The redder colors are the higher appreciation areas. Livermore used to be up there, but I think what's happening is people are getting called back to work and they're trying to get in the mid-range area now, which is where the appreciation is the strongest. And San Mateo County is the coolest by far. You can see how solid blue that is, as well as the island of Alameda and Berkeley. And also honorable mention is South County and Santa Clara County. Here's the sold price, and instead of following the median, which is the middle number, I sandwich that by adding in the 10 percentile, the number on the left, and the 90 percentile, the number on the right. You get a sandwich. You know what price range each one of the micro market areas is going to be. So you still have the outlying areas being more affordable in a nutshell, and the closer in areas being the more expensive areas. Here's a summary. You can start off on the micro market area on the left, or come over and either pick the payment you're looking for or the purchase price that you qualify for after meeting with a lender. Come across and look at the market conditions. The highlighted ones are sort of leading indicators. The orange are lagging indicators because you need the sale price, which adds about a 5-week delay factor into it. Here's the raw numbers for either Silicon Valley, Santa Clara County, San Mateo, or Alameda County. Can look through what's important to you. The big takeaways is the number of new listings is down as we approach the end of the year holidays. Total inventory is down, offers is down, but with that going on, and typically at this time of the year, the speed of the marketplace is measured in the turnover rate actually goes down, which is a faster paced marketplace, and that's exactly what's going on. This slide's on here to show you that at 1538, we're no longer the record low year. We haven't been the record low for a while. Both 2023 and 2022 were lower. And then on the 25-year average, there's a third one of 2007. Lack of number of offers is still a fairly key component to the current market conditions. We've been talking about Silicon Valley real estate market. We will talk about the Greater Bay Area pretty soon. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers in single agency transactions here in Silicon Valley for several years now, back to 1981. If you type in the blue URL or the green root URL, which is shorter typing for you, you get to the archives on YouTube. I put up my presentations there, and you can go back and watch any ones you want to see. If you want to join the presentation live Saturday morning at 9 a.m., you type in the green root URL 2024, soon to be 2025, to get to the meeting. If it asks for the passcode Zoom, it's right here for you. If you want the handout, it's a 67-page PDF of the slide presentations that we went over. Type in the green root URL, H for handout 2024, 12 for the month, and 14 for the day. Any specific episode, the same thing, but drop off the H. So just the green URL, year, month, date code. Again, I'm Richard Calhoun, Creekside Realty. Appreciate it if you subscribe if you're watching for the first time, and appreciate likes on each video you watch. Not seeing any unmuted mics, we'll move on to the Greater Bay Area, 5 regions and covering 13 counties in Northern California. Here are those regions and counties that we're going to cover. The areas are pretty self-explanatory. Here's inventory. You can see inventory is down in all the 5 regions, down the most significantly in Silicon Valley in the purple. Number of offers is also down most significantly in the purple. Probably the most noteworthy thing is Central Valley in the yellow has gone up in the last couple of weeks and actually has increasing number of offers. Very unusual. I have not observed that in any of the past 11 years. It's the wrong time of the year to be seeing increased number of offers, but that's clearly happening. The other 3 regions are down a little bit overall. So you have Central Valley bucking the trend and going up, and you have Silicon Valley taking the largest decrease in offers. You're looking at days of unsold inventory. Silicon Valley is the fastest pace, followed by the cities. Central Valley has shown a huge improvement with the increase in number of offers, but it's still third place at 60 days. Then North Bay, and the slowest area, the longest turnover rate is the Central Coast. Here's marketing time. You can see marketing time is going up fairly significantly in all the regions. Silicon Valley is up. The cities is up probably more than Silicon Valley. The Central Valley is up quite a bit. The North Bay is up quite a bit. The one that's up the least is the Central Coast. This is seller price reductions. Cities has done the most price reductions, and it's not currently at the most, but it's increased. It's changed the most. It's gone from something like a 1.4% price reduction to a 2.8% price reduction, and it's done that in just a short order, a short time frame. Silicon Valley up here in the purple is seeing the least price reductions with just over 1.2%. Then you have Central Valley in second place, North Bay, and then tied for last is the Central Coast and the cities area. Again, I think the most noteworthy thing is the large increase in the cities on the magnitude of the seller price reductions. Here's the frequency, and you can see the frequency has increased. So it's probably the increase in frequency in the cities that's causing the average to increase. You've had a little bit of an increase in Silicon Valley, but it's still the least common at only 20%. And the overall most is the Central Valley at somewhere around 36% of the sellers, just over a third. And it's noteworthy, you got Central Coast and also North Bay right at a third of the sellers doing a price reduction. And I guess cities is really there too at 31.5%. That's not very far from 33. Here's your overbidding for the area. So the city has the most overall bidding at just shy of 6%. Silicon Valley is somewhere around 5.25%. Then you jump down to just over 100%. So somewhere around half of 1% for the North Bay. Central Valley is actually next, fourth place, but it's actually a price reduction of, probably about 1/4%. And then the Central Coast is taking the most reductions, and it's somewhere about a 1% price reduction on average. This is the frequency of overbidding. Silicon Valley is the most at about 62%, followed by the cities. Then you jump down to 40% for the North Bay, about 36% for the Central Valley, and 32% for the Central Coast. Here's the long-term appreciation. Probably the most noteworthy thing is the low appreciation rate for the cities. Then you have North Bay next, and then you have three that are doing fairly similarly, which is what you would expect. You can see how similar they were before the pandemic, and the cities has really broken out and done underperformed since the pandemic. Here's the sold price. You can see that the Silicon Valley in the purple is just above the city's median price now, which the cities is Marin and San Francisco. Historically, the cities has been the higher of the two. You can see it's changed over. They've become equal for most of 2023. So the cities went below here for a short period in the third quarter. Then it rebounded in fourth quarter and was above, but now it's just crossed over and is again below. So some horse trading, but the big takeaway, in my opinion, is, basically before the pandemic, there was a significant and constant difference with the cities always being more expensive. And now we're basically neck and neck with each other. The Santa Cruz, Monterey area, the Central Coast is in between, right in the center of the pack. North Bay is a lot more stable. And then the Central Valley is the most stable. And you can see that prices have been fairly stable for a while, but currently at 5,500. Here's the monthly payments. They're going to be in the same order. The Silicon Valley is the highest, followed by the cities, and then the others are in the same order. You can see payments have climbed even if house prices haven't climbed. And you can see it really in Central Valley where, prices have been flat since 2021, but look at your mortgage payment. Your mortgage payment went from just a little over $22,000 up to $4,000, and maybe now about $4,100. So payments have come close to doubling, even though prices really haven't changed. Here's the numbers with the metric across the top, the different cities down the side. I do have Silicon Valley as a region since that's what we're focusing on. I also have the Bay Area, but it's mostly there because the media covers it. I think it's a garbage number. And if you look at any metric and look at what the number is for Bay Area, and then look at the range of the 9 counties that make up the Bay Area, the range is pretty significant portion of the overall number. So it's there more for out of interest than anything else. I don't think you can really tell what the market's doing on the Bay Area wide basis. And with that, we're back to the summary slide. These are the chapters you can go to and jump to using the timestamp links in the YouTube description below. And with that, I'm not seeing any unmuted mics, so have a great week. Take care. Bye for now.